To catch all the latest on the Business and Economy Literature Fest 2025 by the TV9 Network in Kolkata.
But now, of course, it is easy to learn that, and always think when somebody is advising you something, what is their incentive. So you have to do your own evaluation. Unfortunately, I can't say that rely on X, Y, Z. And just as a broad thing, one thing I'll tell you that when I'm talking of, let us say, even equity investments, don't look at very narrow themes that should I be in small caps now, should I be in defense today, should I be in pharma, because those themes change. So invest in something that is broad-based, that is multi-cap or flexi-cap. Because one thing I can tell you, I repeat it often in my interviews, and that is the truth, that the easiest way to find where there is froth in the system is where all the mutual fund, NFOs or new fund offerings are coming. When there's a cluster around a certain theme or a certain industry, and this we have plotted, we are very data driven, so we've actually plotted it since the mutual fund industry began. And it is always near the peak of that theme. When there is a FOMO feeling that my friend has made money in defense stocks and I haven't, and so the next defense stock NFO that comes, let me invest. So be wary of things like that. So just invest in the broad categories. Don't think you will be this genius who will find the next big thing. So don't be in pursuit of that next big thing.
Yeah. So it's also about not doing it yourself, but doing your learning, because your learning will help you and get guided on what you need to choose.
Yeah, I mean, whether you should be a do-it-yourself investor, there is a chapter on this, but which is really evaluating, and which was my last column in Mint also. I write a fortnightly for them. Whether you should be a DIY investor, you have to evaluate yourself as a fund manager, and you may not be the best fund manager, but you can still allocate your money. The other, I would say, big mistake often people make is being on either end of the risk spectrum. Like if you are only in fixed deposits and you are saving $1 lakh a year over 30 years, that will become 75 lakhs. If you are in a multi-asset thing, which maybe compounds 9.5%, it will become 1.5 crores. If you are in a more equity-oriented portfolio, which compounds 12%, that becomes 3 crores. So that's like a difference of 4 times. So, but don't think, this also I find sometimes people are totally not even in equity, and then suddenly think they will become, after retirement or something, that I'll become a day trader in crypto or derivatives. So don't play fast and loose with your money either. As I said, do the boring stuff.
Yeah, so asset allocation is that much more important then.
Yeah, and one other mistake, of course, on asset allocation, is that people think of asset allocation as allocation in various assets within India. The biggest gap in Indians' portfolio is global diversification. So one number, when I started working, the dollar was 12 rupees. So in the course of less than a career, there's been a 90% depreciation. And this is something you cannot forget when you are saving for goals which are 10, 20, 30 years later, that the rupee depreciates. And that is the biggest gap. And that comes out of a mindset, because long after I started working, you could not invest overseas. Not only that, you could, even if you were traveling overseas, you could take only $500, and that too once in 3 years. If the second time you were traveling or the third time you were traveling, you actually went with $20 in your pocket. That's all you were allowed to take. So our grandmothers were not wrong in buying gold, because at that time gold was the only overseas investment effectively that you could do. That was the only hard currency denominated asset. But now you can invest overseas. In fact, the RBI's LRS, Liberalized Remittance Scheme, is very generous. It is $250,000 per person per year. So a family of 4 can send out $1 million. That's 9 crore rupees a year. So effectively for everybody, they can send out as much as they want. Just in 2025, for anyone who was planning to study abroad or who's planning to send the children to study abroad, and thought that Trump's visa regime is not getting uncomfortable, so one should go to Europe. In the course of this 1 year, the rupee has depreciated against the euro about 20%. So the college bill has gone up 20% in just 1 year. So this is the other biggest missing part in everyone's asset allocation, most people's asset allocation. And because it is a cause for me, and global, other mistake is thinking global means just the US. No, US is not the world. So we have a product that starts at $10,000, which invests in all countries, all assets. Because as I said, it's a cause for me that Indians have this big missing part in their portfolios.
Yeah, so international currency exposure, in spite of the fact that we believe that our economy will do very well, but still it is important to diversify.
Yeah, so just
currencies.
The answer to that is in the 90s, we say that if India is the highest growing economy, why should I look elsewhere? So in the 90s, which were the highest growing economies? They were the so-called Asian tigers. And then came 1 year, just 1 year, in which there was a crisis. And in that 1 year, each of those markets in dollar terms fell between 50% for Taiwan and 90% for Indonesia. And all this South Korea, Thailand, Philippines were between this 50 and 90. And in my Citibank days, I had gone to set up their Indonesian securities subsidiary. So I'd spent a few months in Indonesia. And that was like, it was said like if I was an Indonesian, my net worth would have been wiped out by 90%. And that was one of the motivations for me to go global, that being in a single market is dangerous. Don't put all your eggs in one basket. That's the simplest way to put it.
Absolutely.
And India is on less than 5% of the world market cap. So there's no reason, no objective reason why 90 or 100% of your investment should be here.
Absolutely. Coming back to the book, there is this 9 mantras. I wish the listeners can get a sneak peek into the 9 mantras. And one line I just want to quote, which has caught my eye, mind, everything, is that don't be bearish, don't be bullish, be what, ma'am?
Be harish.
Yeah.
So this is when we were thinking of a company mascot. I did some research that what's a good animal. And you found the hare, because the hare is very fast, but it can move directions also equally fast. Because in markets, one thing is for sure, that no theme lasts forever, whether it's country, asset class, sectors. So you should be able to change direction. The other thing which a hare has and which one aspires to is a near 360-degree vision. So, those were the qualities. So, basically, the thing is, don't get married to a position. One of the basic things that make us human is stories. Human beings are creatures of the story. And that is one thing which is common across all civilizations, across time, across degree of sophistication, is that we learn through stories, we teach through stories, we remember stories, we react to stories, we don't react to data. If I tell you today that, in the 2 districts around Kolkata, there are 5 lakh malnourished children, you will turn the page. But let me show you a picture or a video of a single family that is starving, you will give money to that charity. So ads are always stories. But stories are what hold you back, because the market is not a human being. The market doesn't care for your carefully crafted stories. So as a investor, you have to be driven by data rather than stories. And that is why you should not be married to a position. You should not fall in love with any story or any position in your head. That's so important. And that's where, a lot of I'm not talking lay investors, but that's a trap for human beings who act as fund managers. And the funniest thing about stories is that you tell a story enough times, you start to believe in it. And I can give you, many examples from professional fund managers that you start kind of selling a story, and therefore you can't change that story even in your own head. So you have to actively guard against that. I always say that for me, my kind of hero, my guru, my pin-up boy is Daniel Kahneman. And both his books are among my top 5 of all time, and I read a fair amount. And that really opens your mind to how much human beings are creatures of the bias. And that holds for all of you in whichever field you are in, even outside of investing, that so many biases are hard-coded into us because of evolution. So, and even if you intellectually understand it, it is difficult to get it out of your actual behavior.
Another question that comes to mind and is very relevant in today's investment world is that what's your take on active versus passive, and how should you include active or passive or both in your portfolios?
Okay, so one thing is, see, to a lay person, it appears that passive is somehow lower risk than active investing. So passive investing for, not everybody will be a finance professional, means buying something that tries to replicate the movement of the index. It may not exactly mirror it, there's always errors, but basically you are not trying to choose stocks actively, you are just doing what the index, you are trying to replicate the index. So that's essentially what passive investing is. But I'll tell you what the value of an active fund manager is. And that's only one thing, risk management. So even when you are talking to somebody who's a financial advisor or a fund manager, everyone will have a very elaborate presentation, I can guarantee you, on how they pick stocks. Ask them when they sell. What is their process for deciding when to sell? What is their process for risk management? And then you will come to know what their depth of their understanding is. Economic Times a while back did this analysis of mutual funds, and they were surprised by the results. I was not, which was that they found that the best performing mutual fund schemes are the ones that outperformed during the downturns. In fact, there was one scheme which had outperformed during 93% of the up moves, but was among the bottom schemes because it fell more when the market fell. And investing is a loser's game. You have to play it not to lose. You don't have to play it to win. I mean, there is an old article, it's a 1970s article, and I urge everybody to just Google and read it. It's 4 or 5 pages only. Charles Ellis, called The Loser's Game. It's always been part of my training kit. And which is that every game in the world is either a winner's game or a loser's game. Games change, and you play it according to what kind of game it is. Like tennis at the Grand Slam level is a winner's game. You have to play brilliantly to win. At your local club level, it's a loser's game. You just keep the ball in play, and your opponent will make enough mistakes for you to win. So in investing, your first and primary thing has to be that you don't take a big loss or a big hit on your capital, which means you have to take some small losses. So you always have, we always have stop losses, but you don't take a big hit because percentages are not symmetrical. If something falls by 1/3, it has to go up 50% for you to go to zero. If something falls by 50%, it has to double for it to go to zero. So you have to make sure that you don't take those 30-40% hits, and that's where active fund management, that's where the real value add is. But not every fund manager is thinking that way, so you have to look at what the fund manager is saying and doing on that.
I also agree with you that risk management is a pivotal element in investment, and risk is a very, movable thing. It changes from time to time. So your risk assessment must be controlled and figured out, and then investment must be done. Yeah. Going back to a different topic is that the buzzword today is AI. And how will AI get incorporated into investment processes? So your take on investments through AI, with AI, without AI, and the conclusion from there that we can draw.
Okay, so let me first tell you that I told you I started my PMS in 2020. I actually had the license for 20 years and I had not started. And the reason was very simple. I didn't mind being the first to go global. I didn't mind being kind of the last to start a PMS. They said that I must have a system whereby I can say the results are somewhat predictable and consistent. And that actually came with an AI/ML system, not as a black box system. But I'm not using AI and ML because it is available or because it is fashionable. So let me give you another sports analogy. So, I mean, the younger people at the back, do you know why hockey is India's national game? After all, I mean, for 50 years, we did nothing in hockey. So why is it our national game? randomness which human beings bring. I mean, human beings are random creatures. You have a fight in the traffic, you will look at the same data differently today at work. I mean, they've found that in one of Daniel Kahneman's books, if you want relief from a judge, if you want bail from a judge, don't go before lunch. Go after lunch. I mean, there's a statistically significant difference. So that's how random human beings are. So this removes all of that. Plus, I mean, human beings hate to admit mistakes. Machine has no problem learning from its failure, learning from its success. But a pure techie system also doesn't work because you need the market expertise. Otherwise, you can misuse computing power to come up with spurious correlations. So we use what we call a human plus machine system, which is that the machine does the first level filtering, but not as a black box. We can see which factor is moved. And then we apply human intelligence on top of that. But in general, systems outperform human judgment. So you overrule a machine only if you have a good reason to overrule a machine. I mean, this is called a broken leg analogy, that a machine will better predict whether someone will go for a concert unless you know for certain this person has broken their leg and cannot go. So you should not overrule, because otherwise you overrule because of your persistent stories, that this company or this sector is useless or it is very good, either way. So you human being, that persistence of vision appears and you don't change your stories even though the data has changed. So the machine forces you to look at the data.
Yeah, so AI will be extremely important. I was looking at a credit company, all their credit analysis is done in minutes.
Yeah, and now seconds, I mean, they're like,
seconds,
they're like, but I mean, the crazy thing in that is I was on another panel recently with somebody who was in that business, and they said basically what we do is we analyze the potential borrower's entire SMS and WhatsApp history. I mean, I was like shocked, and that's what they're doing. They're looking for patterns there, that are you delaying utility bills? Are you having problems with close associates? So, I mean, this is but they use all that to come up with a credit score.
Yeah,
and
even companies, if you look at, you get all information about directors, if there are pending case against him and so on and so forth. So much of data is available, and if you can use it, it's speed, all about speed. The next question aligned with this is with AI. We know that there is machine and machine learning. But what about empathy? What about management of behavioral science? So where is that going to, will it going to remain? Will it going to go? People say doctors might go, nurses will remain. Because doctors' operation can be done by machine, but nurses' empathy cannot be replicated. So what's your view on that in this world of investments?
So in investments, see, anyway, even when we were doing it humanly, I always said that all stories must be borne out by data. If you're saying this company's management is good or this company's brand is good, I mean, brand is great, where does it come? I mean, is their market share more stable when the market falls? Do they have more pricing power? Is their margin higher? Somewhere it has to come. If the management is good in the last downturn, did they manage their receivables and payables better than the other competition? So, I mean, I'm not sure that the empathy part is there, but actually the thing is that I often see that numbers also you can understand, but getting control of your own mind as an investor is the real tough ask. Because that is so hard-coded, because see, a lot of the biases we talk about have not come arbitrarily. They have come because of human evolution. So let me give you a non-investing example, which is that every time the new iPhone comes, there are all these queues, and there is like this data that 70% of iPhones in India are financed. They are not bought with outright cash. And, you know, people want whatever, Gucci bags and Tumi bags. And so that also actually comes from our hunter-gatherer days. That's it's not that you want to buy the Gucci bag, it is that you want to belong to your tribe. Because, I mean, human evolution has no interest in your portfolio. It's interested in only two things, procreation and survival. So if you were thrown out of the tribe or you walked out of the tribe, your procreation was gone and survival also was in question. So we are progeny of people who stayed with the tribe. So in investing, for example, everybody wants to be on the same bandwagon. It is very difficult to be in the minority of one and say, I'm doing something different from what all my friends are doing. And it's not even about spending money. If you, let's say, wanted to belong to a different sort of tribe where the uniform was a jhola and torn jeans, and you wouldn't be caught dead with the Gucci bag. So that's where, so it's very interesting to learn about your biases, but it is also, without a system, it is impossible to get over your biases. When Daniel Kahneman worked 70 years in this field, he got a Nobel Prize for it, and he said, after all this study, my own decision-making has barely changed. It is that hard-coded.
Yeah, behavior is something which changes from time to time. We have seen customer investing the most when the markets are at peak and things like that. So those are...
Yeah, I mean, actual data shows that sentiment is a contraindicator. That when everybody is feeling great and buoyant, which was the first half of 2024, when everybody thought, 30% every year was a given, that, post that the returns are below normal. And when you are feeling down and out, should I stop my SIP? Should I get out of the market? The returns after that in the next period are above normal. And this is not just India and US, everywhere where this research study has been done, Portugal, Brazil, etc., same conclusion that the only time you should think of actually stopping the SIP maybe is when you're feeling too good, not when you're feeling too bad.
Yeah, so that should be the process flow. My last two questions are, one is that in your book you describe a lot about study of balance sheets, ratios, cash flows, discounting cash flows, etc. How important is to study them? And is for a common investor, is that easy? And if not, is there a guide who will guide you through that process? How important is that first?
See, now, of course, if you want to learn, all the information is out there. You can even do the courses of major universities for free. So that is not the point. But do you want to do that? Do you have the time to do that? Which is why I said that for most people who have a day job or a day business or whatever, the better thing would be to give the money to professional fund managers. If you just want some money to learn and to be able to talk at parties, maybe keep 10-20% for yourself. So it will only be the exceptional person who can do that. But those who want to do that, I have given some of the tools. And one of the main things is to go beyond the income statement. That this is the sales growth, this is the margin growth, this is what happened to profit. Because everything hides in the cash flows and the balance sheet. And the companies also very well know that you look only at the income statement. So when there's a problem in the company, they will try to keep the sales and profits protected by, let us say, telling their customer that instead of 15 days credit, you take 2 months credit. So first it will show up in stretching of receivables and so on, or lower cash flow. So there are many things you need to do if you want to really do professionally, but not many people will have the time to do it. And also remember that Excel sheets are the best place to write fairy stories. So all this, projections the way people do for 20 years, the fact is that even, every research report you pick up will have earnings growth every year, cash flow growth every year. But out of 4,000 odd listed and traded companies in India, only 10 or only 17 have shown some profit growth. That means there was no profit decline for 10 years has happened only for 17 companies, 17. Only one company has not seen a profit decline for 20 years, which is HDFC Bank. So, I mean, it is as exceptional as that. You would not know it from looking at discounted cash flows. So that is why in our PMS, every quarter we look at that today if I had cash, where will I be invested? Because otherwise, endowment bias is one thing which is again very hard-coded within us, that we value something more highly simply because we own it. And that is why we don't get rid of the dud investments in our portfolio. So that's one tip I can give all of you, that you will have many dud investments, get out and get into better investments.
Yeah, that's right. So when you look at your Demat account, you might find many companies which we have been in love with, but not showing the results. My last question is, we're licking our lips with the book that you have put. What is the next one out?
There will be probably in 2026. I'm trying to make that one little even more basic. All the questions I get, that what should I do specifically? So I'm really trying to answer the questions and maybe use some infographics to make it simpler.
Great. So if you have any questions, just post it to Devina. I'm sure she'll be able to answer in this next book. Thank you so much, ladies and gentlemen. Wonderful conducting this format. Thank you so much.
Thank you very much.